There is an IRS rule that most people claiming Social Security before 67 have never been warned about. Not by their HR department, not by the Social Security Administration, not by the person who helped them file, and it does not just reduce what you keep. In certain income situations, it can claw back up to 85 cents of every single dollar of Social Security you receive, legally, quietly, and automatically. Most people think claiming early just means a smaller monthly check. They accept the reduction, they do the math on what they will receive, and they plan around that number. What they do not plan around is what the IRS does to that check after it arrives. Right now, there are millions of retirees collecting Social Security before their full retirement age who are handing back a portion of that money every single year without ever understanding why the number on their tax return does not match the number on their benefit statement. And the gap between what they expected and what they actually keep is costing some of them $3,000, $4,000, $5,000 a year on income they already waited decades to collect. Today I'm going to show you exactly what this rule is, who it hits hardest, what the actual dollar damage looks like by income level, and what you can do right now in 2026 to reduce the impact before your next tax filing. This is not a general overview of Social Security taxation. This is not based on a headline or a number your neighbor quoted at the kitchen table. This is based on exactly what the IRS does, line by line, to your Social Security benefit when you claim before 67 and still have other income coming in. Pension income, IRA withdrawals, part-time work, investment dividends. We are going to put real dollar amounts on what this rule costs real retirees in 2026 so you know precisely where you stand. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is John Retires. Every week, I break down the IRS rules, the tax traps, and the retirement strategies that protect your income from the things nobody else is taking the time to explain. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me start with the rule itself because most people have heard of it, but almost nobody understands how it actually works against early claimers specifically. The rule is called the combined income formula, and it is the IRS mechanism that determines how much of your Social Security benefit is subject to federal income tax. Here is how it works. The IRS takes your adjusted gross income, that is your wages, pension, IRA withdrawals, investment income, and adds it to half of your annual Social Security benefit. That total is called your combined income, and where that number lands determines how much of your Social Security gets taxed. If your combined income as a single filer is between $25,000 and $34,000, up to 50% of your Social Security benefit becomes taxable. If your combined income goes above $34,000 as a single filer, up to 85% of your Social Security benefit is taxable. For married couples filing jointly, the thresholds are $32,000 to $44,000 for the 50% tier and above $44,000 for the 85% tier. Now here is where early claiming makes this dramatically worse, and this is the part almost no one explains. When you claim Social Security at 62 versus 67, your monthly benefit is permanently reduced, typically by 25 to 30%, depending on your birth year. That part most people know. What most people do not know is that the combined income thresholds, $25,000, $34,000, $44,000, were set in 1983 and have never been adjusted for inflation, not once in over 40 years. In 1983, those thresholds captured a small percentage of retirees. Today, they capture the majority, because wages have grown, pensions have grown, IRA balances have grown, and the thresholds stayed exactly where they were 4 decades ago. So here's what happens to an early claimer in 2026. You claim at 62. Your monthly benefit is reduced from what it would have been at 67. You are receiving less. But you are also likely still pulling from an IRA or a pension to cover living expenses because you claimed before your full retirement age. That additional income, the income you are drawing to make up for the reduced benefit, pushes your combined income up. And that higher combined income pulls more of your already reduced Social Security benefit into the taxable zone. You took a smaller check, and then the IRS taxes a larger portion of it. That is the trap. And it is entirely legal, entirely quiet, and almost nobody walks you through it before you sign the paperwork to claim early. Let me put actual numbers on this so you can see exactly where you land. First example, single filer. Claimed Social Security at 62, annual benefit is $18,000. Has a small IRA withdrawal of $20,000 to cover living expenses. Combined income calculation, $20,000 in IRA income plus half of $18,000 in Social Security equals $29,000. That puts this person in the 50% taxable tier. So $9,000 of their Social Security benefit is now subject to federal income tax. At a 15% federal tax rate, that is $1,350 in federal tax on Social Security income alone, on a benefit they already took at a reduced rate. Second example, Now let us look at what happens with slightly more income. Married couple, both claimed at 63. Combined Social Security is $32,000 per year. They have a pension of $28,000 and a small IRA withdrawal of $12,000. Combined income, $28,000 pension plus $12,000 IRA plus half of $32,000 Social Security equals $56,000. That is well above the $44,000 joint threshold. 85% of their Social Security, $27,200, is now taxable income. At their effective federal tax rate of 12%, they are paying $3,264 in federal income tax directly on their Social Security benefit. On money they already took a permanent reduction to collect early. That is $272 every single month coming back out of a check they spent years waiting for. Third example, and this is the one that surprises people the most. A single retiree, claimed at 62, receives $16,000 in Social Security annually, has no pension, but they have a brokerage account generating $18,000 in dividends and interest per year. Most people assume investment income in a regular brokerage account is separate from retirement income. It is not for this calculation. That $18,000 in investment income counts fully toward combined income. Add half of the $16,000 Social Security benefit, and the combined income is $26,000, already in the taxable zone. Push it above $34,000 and 85% of the benefit gets taxed. This retiree thought they had planned carefully. No pension exposure, no IRA draws, just Social Security and passive income. And the IRS is still taxing up to 85% of their benefit because the combined income formula does not care where the other income comes from. That is 3 different people, 3 different income situations, and the same IRS rule taking a cut from all of them, on a benefit that was already reduced the moment they claimed before 67. Now you are probably thinking, the obvious answer is just to claim at 67 and avoid the early reduction entirely. And for some people that is exactly right. But here is what actually happens when retirees make that decision based on that logic alone. Claiming later is not automatically better for everyone. If you claim at 67 instead of 62 but spend down your IRA for 5 years to cover living expenses while you wait, you may have created a larger IRA balance problem later, specifically around required minimum distributions. RMDs kick in at 73, and if your IRA has grown for 5 more years because you were not drawing from it, those mandatory withdrawals could push your combined income even higher in your 70s than it would have been in your 60s. The real answer is not about when you claim. It is about how you manage the income around the claim, and that is what almost nobody is showing you before you make a decision you cannot reverse. Here is what changed in 2026 that makes this issue different from anything you have read about before. The One Big Beautiful Act introduced a new $6,000 senior bonus deduction for taxpayers 65 and older with modified adjusted gross income under $75,000 as a single filer or $150,000 for joint filers. That is $12,000 for a married couple where both spouses qualify. This deduction directly reduces your adjusted gross income. And because adjusted gross income is the first number that goes into the combined income formula, a lower adjusted gross income means a lower combined income score, which means less of your Social Security ends up in the taxable tier. If you are 65 or older and your income is under those thresholds, this deduction could move you from the 85% taxable tier down to the 50% tier, or out of the taxable zone entirely depending on your numbers. Most tax software is not flagging this automatically. If you filed your 2025 return and did not claim this deduction, you may be able to amend and get money back. The SALT deduction cap also increased in 2026 from $10,000 to $40,400. If you are a retiree in a high property tax state who switched to the standard deduction in 2018 and never looked back, you need to run the itemized numbers again. The math may have flipped in your favor, which also reduces your adjusted gross income, which reduces your combined income score, which protects more of your Social Security from tax. And if your retirement accounts took a hit in the recent market volatility, there is a real opportunity sitting right in front of you. A Roth conversion on a down market means you pay ordinary income tax on a lower balance. Converted Roth funds do not generate required minimum distributions. No required minimum distributions means lower combined income in your 70s. Lower combined income means less of your Social Security gets taxed for the rest of your life. The state you live in affects what that conversion cost you, but the federal math works strongly in your favor right now. Here's what this all comes down to. If you have not claimed yet, run the combined income calculation before you decide. Do not just look at the monthly benefit comparison between 62 and 67. Look at what your IRA, withdrawals, pension, and investment income do to your combined income score at each claiming age. The taxable tier you land in will change the real dollar value of every single year you delay or accelerate. If you have already claimed early, you cannot undo the claiming decision. But you can absolutely manage the income around it. Roth conversions reduce future required minimum distributions. Shifting investments that generate interest and dividends into a Roth or tax-deferred account lowers combined income. Timing IRA withdrawals strategically around years with lower income can keep you in a lower taxable tier and protect a larger portion of your benefit going forward. If you are 65 or older right now, check whether you qualify for the new $6,000 senior bonus deduction and whether the increased SALT cap changes your itemized deduction calculation. Both of these directly reduce adjusted gross income, the number the IRS uses to determine how much of your Social Security gets taxed. The retirees who protect the most income are not always the ones who claimed at the right age. They are the ones who understood what the IRS does to that income after it arrives, and planned around it before the damage was already done. Now you know exactly what this rule does, who it hits hardest, and what the 2026 changes mean for your specific situation. But there is one more piece to this that most people miss completely. The state you live in determines whether your Social Security benefit gets taxed a second time, on top of everything the IRS just took. 11 states still tax Social Security at the state level in 2026. If you live in one of them and claim early, you are getting hit twice on a benefit you already took at a reduced rate. Watch my video on the best and worst states for retirement income taxes. I break down exactly which states are taking the most from retirees right now, and which ones protect every dollar of your Social Security, pension, and IRA from state tax entirely. This is John Retires. If this video helped you understand what the IRS actually does to early Social Security claims, hit the like button right now. It takes 1 second, and it helps this video reach more retirees who need to see these numbers before they make a decision they cannot reverse. If you are not subscribed yet, hit subscribe and turn on the bell. Every week I break down the rules that protect your retirement income, the ones that are not making the headlines but are absolutely affecting your bank account every single month. Drop a comment right now. Have you already claimed Social Security? At what age did you claim, and did anyone walk you through the combined income formula before you filed? I read every single comment, and the most common situations you share become the next video. I will see you in the next one.